Stock prices are somewhat statistical by nature. Any one trade is not super important. Only selling cyclically is beneficial with covered calls and or cash secured puts because in the long run, investors generate some multiple of premiums before getting assigned. There will be some times when the stock goes up or down too much, but in the long run, that's balanced out by the cyclical collection of premiums.
Hello, Wealth Builders. You're listening to Wealth Building with Options. Here's your host, Dan Passarelli.
Hey, Wealth Building with Options family. Welcome to episode 19, the Triple Lindy and Making a Big Splash. But before we jump in today, let's talk about how you can get the most out of the Wealth Building with Options community. First, consider sharing this podcast with like-minded people. Word of mouth is the best way to grow our community for all of us. And the more people you share ideas with and get that frequency bounce back from, the more you grow as a trader. The second thing you can do is to support the show with a paid subscription. For the cost of one fancy Starbucks once a week, you'll get video extra podcast episodes and posts chronicling my covered call and cash secured put trades that I'm making in my real brokerage account. Plus, you'll get access to our monthly Ask Me Anything session and much more. To get all this, go to my Substack at wealthbuildingwithoptions.substack.com and subscribe to the monthly or annual subscription. That link is in the show notes. On today's show, we're going to pick up where we left off a bit, but we're going to amp it up. We're continuing on with the zero fluff stuff that makes cash secured puts actually work. These are the hard-earned hacks that people who know what the WTF they're doing do. I've used these street smart tactics for years, and they work. Some of these things I didn't invent, which is good. It's campfire knowledge. So often people try to figure it out for themselves, whether we're talking about options investing or gardening or woodworking or some recipe. It doesn't work. And it doesn't make any sense either. Some people pride themselves in, I figured it out on my own. You shouldn't be proud of that. You should be ashamed of that. Why spend all that time figuring out something that somebody already knows how to do and a bunch of other people already perfected? That is a terrible, terrible waste of your time. And with investing, time is money. So you're not just wasting time, you're wasting money too. Listen to the elders around the campfire. They know what to do. They're going to tell you. While some of what we're going to talk about today is that campfire knowledge, some of it I put my own spin on. Or rather, it's my way of understanding the story that's been passed down by the elders for generations. So let's get on with it. Let's do a triple Lindy off the diving board right into our topic today. At risk of oversimplifying a bit, one can conclude that indicators on a stock chart generally suggest either that a stock is likely to have movement or that it is likely to not have movement, often specifically in one direction or the other. The word movement in options is synonymous with volatility. Because volatility is the enemy of option sellers, we're looking for something to indicate a lack of movement in the stock, or at least a lack of movement lower, because on this show, we're talking specifically about cash secured puts. Therefore, One of the put sellers' BFFs is the support line. Support lines on a stock chart show maybe not strength, but rather they show more like an inhibitor to weakness, right? Specifically, weakness below a certain price in the stock. And that lends itself somewhat to the skate objective investor, doesn't it? A support line is still useful to the assignment hopeful investor, particularly when the stock is not really exceedingly strong based on some other technical criterion or fundamental criteria in general or anything. So, to be sure, an exceedingly bullish thesis kind of nullifies the whole rationale for a cash secured put because it's a limited profit potential strategy, right? Remember, selling a put has limited profit potential and all the exposure of owning the stock. A big move higher during the life of this single trade, I sell one put and the stock shoots way up. Well, you're not really monetizing all that move. You're leaving money on the table, as they say, beyond the premium that you collected for the put. Good candidates for trade objective investors, and again, that's somebody hoping to get assigned, would have to be a bit more bullish of a thesis. You want to buy the stock because you think it'll go up in the long run. That challenging logic reveals sort of a glaring contrary goal here. An investor who sells an out of the money put needs the stock that they're bullish on to go down in order to get assigned. So therein lies one of the key tenets to be weaved throughout this podcast series. Stock prices are somewhat statistical by nature. Any one trade is not super important. Only selling cyclically is beneficial with covered calls and or cash secured puts because in the long run, investors generate some multiple of premiums before getting assigned. There will be some times when the stock goes up or down too much, but in the long run, that's balanced out by the cyclical collection of premiums. So yes, the presence of support on a chart, it definitely helps the trade objective crowd, and support is definitely one of the most fruitful edge sources for skaters. The buy orders that were at that horizontal support line's price in the past, absorbing all those sell orders that came in and still bidding for more, the sell orders couldn't take out all those bids. Those bids are presumed more likely than not to still be there. And the more occurrences of inflection points at that price that the stock hit in the past and bounced and retraced higher and bounced and retraced higher, the more likely that support price is to hold. This is a tried and true approach with empirical merit. It's hard to find an argument against using support on selling your cash secured puts or even for other reasons. And that's probably why so many chartists use support and resistance in their analysis. It's important to always factor theta into decisions aimed to arrive at the optimal strike, expiration, and either whether or not to make the darn trade at all. Theta, in and of itself, as the 1 day decay of the put value, look, that's a great starting point. It does its job. Now, the aggregate theta, as well as breaking that aggregate theta down into comparable time chunks, that also provides great benefit. And we're going to talk about the difference between straight theta and aggregate theta in just a couple minutes. Now, this 1-day theta, the traditional straight theta, is a good mirror under the nose test for option sellers. In a sense, it answers the question, hey, look, is it worth to be short this option today? Today being the operative word. In any given day, a stock can pretty much do anything. Anything that is within the framework of the probability curve stocks are observed to, or at least believed observed to adhere to. Most of the time, smaller moves are prevalent. That's what those probability curves show, those log normal distributions. Every now and then on those distributions, one of those bigger moves happens, right? Once in 2 blue moons or so, you get a massive move out of nowhere that catches you off guard. This is one of the biggest logic things that people miss, or at least novice traders, to be fair, even somewhat experienced traders miss. What theta really tells you is the theta collected today worth it to keep the risk of a bigger than normal move happening today? And on any one day, you might say yes, but when you're doing that every day, many days in a row, like arguably, if you make this your thing, you're probably doing it every single day, at least on some stock. It kind of reframes that question a little bit, right? Is the theta collected today worth it to carry the risk of that bigger than normal move happening today, right? And so these somewhat bigger than ideal moves, they are going to happen. And if you're doing this on a lot of stocks every single day for years and decades, you're going to see this a ton of times. And it's okay. So it's important to take a longer term study and look at what I call aggregate theta over a certain period to help understand if it's rational to make this trade at all, but also to decide among different put choices in terms of strike or expiration. So let's kind of define these two terms here, and let's go through some conceptual examples. A visual example of this will be available as a video extra for this episode. Straight theta. So straight theta is just, if you look at the theta in an option chain and it says 0.07, it's 0.07. That's it. That is what the theta is today. 0.07 is 7 cents of option premium, all else held constant. And tomorrow, the option will be worth 7 cents less. If the stock moves, if implied volatility changes, you make those changes with delta and vega respectively. But straight theta is just the theta. All right. I'm calling it straight theta just because I want to separate that from what I call aggregate theta, which we'll talk about in a second. And sometimes this can be a little bit tricky too. Sometimes it doesn't make as much sense as it should on the option trading platform, your brokerage platform. Sometimes, especially when we get closer to expiration, the numbers don't really add up right. And that's something also I'll talk about in the video extra. It's kind of hard to do just verbally here. And once we're looking at the theta, that's after we study the chart and the fundamentals and volatility and all the guidelines that we talked about in our last podcast episode. And then as a result of the analysis, now we're zeroing in looking at the theta. And one thing to know is that sometimes the thetas on the option chain on your brokerage platform, sometimes they don't really make sense. Like sometimes there'll be like 35 cents of option premium left. Like you can sell the option for 35 cents, but the theta's 9 cents a day and there's 7 days left. Like that math just doesn't work out. And that happens. I'll try and go over that somewhat in the video extra as well, just to kind of clarify so you can see what it looks like. Now, the next thing to talk about is weekend theta. So here's the thing. When it comes to option valuation, okay, not option pricing, but option valuation, it's based on a 365 calendar day year. Okay, you get an extra one in leap year. And that's because on the weekends, the underlying stock can revalue. Now, it's closed on the weekends. The stock market is closed on the weekends. That's like a near 24-hour a day, 5-day a week thing. But I mean, if over the weekend something wonderfully miraculous happens for the global economy, well, everybody knows stocks are going to be up when it opens on Monday. Or something terrible happens over the weekend, everybody knows stocks are going to be down, whether that's for the market in general or for a specific company, either way. So conceptually, the value changes 365 days a year. So that's why theta is a 7-day figure. It's 7 days a week, 365 days a year, because the model creates a value for every day, including Saturdays, Sunday, and holidays. But you can't trade Saturdays, Sundays, and holidays. So because of that, the market tends to take the volatility. Well, let me phrase that a little better. Because of that, the market tends to take 3 days of theta out by Friday afternoon. By Friday afternoon, market makers typically set their models to be trading on Monday morning's days. And it can tend to start coming out on maybe Wednesday afternoon, certainly by lunchtime on Thursday. By Friday morning, market makers might already be trading on Saturday's days, especially if there's nothing really going on. So they call this process taking the weekend out. Okay, taking the weekend out. And I say market makers move their data ahead, and it's really not the market makers doing this. They're just reacting. They're reacting to order flow. How this really happens is the big firms that are long a lot of options and need to cover 3 days of theta by their gamma scalping. Well, they start selling those options because they don't want to lose 3 days of theta. And when those options are getting sold to the market makers, they lower their implied volatility to lower their bids and offers so they don't buy anymore, and so they sell some. And so what is a little bit weird about theta, especially when it comes to taking the weekend out, is how it can intermingle with volatility. See, here's the thing. The options pricing model is like a model. It doesn't have a brain. It's just a bunch of math. But I tend to kind of personify it a little bit when I talk about it. So when Goldman Sachs comes and starts selling options to the market makers, and the market makers move their day ahead by a day or by 2 days or by Friday afternoon, 3 days, well, the model doesn't know that. So the model just looks at it and says, options are cheaper. Must be implied volatility being lower, because models don't change the days. That wouldn't make sense because it kind of happens organically. And so sometimes it just looks like implied volatility is lower, especially on late in the day on Friday, when it's actually the days being taken out. Now, when it comes to comparing straight thetas, this is where you can really make a big splash in your trading. This is such important stuff. When we look at which option we're going to sell for our put, yes, the support line comes into play. We want to sell options at or below support. Our time horizon comes into play. A lot of things come into play. Volatility comes into play. But we really prefer, in a perfect world, to sell the option that has the highest theta. And if we're close to the money, that tends to be the short-term options. If we're further from the money, it might not be the shorter-term options. It could sometimes, and often is, be the longer term options. And that's why I can't just give you a rule of thumb and say sell the short term ones. I have to say, look at the option chain, look at the thetas, and have that be one of the criteria that helps you make your decision on which option to sell. Now, aggregate theta, this is something different. Aggregate theta is not just that 1 day figure. If we look at full aggregate theta, what that is let's say we're looking at an option that has 7 days until expiration, and I can sell that option for $1 and it's out of the money. Well, by expiration over the next 7 days, the aggregate of 7 individual days, that option is going to decay $1. That's how much time premium, non-intrinsic value that it has. And so that is its total decay. Now, today's theta might say 8 cents, right? And if it's close to the money, the theta might get bigger as time passes, and it all adds up to $1. Again, notwithstanding the fact that sometimes your brokerage platform can be a little funky and give you some numbers out of whack. But so as far as this aggregate theta thing goes, let's say you're looking at a cash secured put and you see support that's really, really solid, a fair amount below where the stock is, but not too much. You can still sell options at that price. And you look at the 28-day options and the 21-day options and the 14-day options and the 7-day options. Well, we can take that aggregate theta for each of them, but we can break them down into common units. Instead of looking at the 7-day as 7 days of theta and the 14-day as 14 days of theta, we can say, oh, well, the 7-day aggregate theta is this. The 14-day aggregate theta, we can divide that into 2 7-day periods. The 21-day aggregate theta, we can divide that into 3 7-day periods, and 28-day and 4 7-day periods. And we can say, which of these gives us the better 7-day aggregate theta? Man, you do that, and you've got a really important data point. You know why? One of the reasons is because then you could say, oh, well, if I sell the 7-day theta, the options that actually do expire in 7 days, I can collect $1. But the 14-day, that's trading at $2.16. So that's $1.08 per 7-day period. So is it better to sell the 7-day one and then when it expires, sell another 7-day one? No. That's $1 plus $1 is $2. Whereas the 14-day ones at $2.16, well, that's $1.08 and $1.08 over the next 2 7-day periods. You start thinking about it this way, now you've got something really super powerful. And that's notwithstanding that there is a slight advantage to choosing the shorter term one, the actual 7-day one. Why? Because if and when the stock goes up or down, you can choose a different strike 7 days later. So that kind of has to be balanced against this aggregate chunking of theta as well. But this is one of those things that it's not really campfire knowledge. This is one of those things that I discovered from just trading this for decades. And it's really, really useful. Another thing I want to talk about is volatility and skew. In one of the last podcast episodes, I made the case that it's optimal to sell options when they're overpriced. In fact, I probably talked about that in a few of our last episodes. I mean, that's like a whole big part of this whole thing. One of the underlying tropes that goes through this entire podcast series. You sell options if and when they're overpriced. In the past, I probably just talked about it with calls, but the logic goes for any option selling. It goes for puts. And in fact, even for more active traders, it goes for spreads, iron condors, credit spreads, butterflies, the whole shebang. One of the things that we talked about also is that there is a risk premium that's measurable in the long run, meaning options tend to be generally overpriced statistically. And we discussed that we can fine tune the data and use volatility analysis to pinpoint opportunities when options are measurably overpriced. And then we can choose to only sell them under that circumstance. Of course, that's with all the other criteria that should be part of the full analysis. So in short, implied volatility is a measure of how cheap or expensive an option is. That is as true for cash secured puts as it is for covered calls. There's no need to rehash some of the stuff that we covered in a few episodes ago when we talked about this for covered calls. If you missed that, go back and listen to it. It was just a couple episodes ago. Go back and, I don't know. I mean, I binge podcasts. So for today, let's expand on volatility nuances, especially when selling puts, by revisiting that same concept that we introduced before. Volatility skew is what I'm talking about. There are two types of volatility skew: vertical skew and horizontal skew. Horizontal skew is also called term structure of volatility, or just time skew. So both vertical skew and term structure of volatility, they're both important for covered call and cash secured put analysis. Term structure of volatility is the observation that options with the same strike price, but with different expirations, have different volatilities. Term structure of volatility is an excellent criterion to add for selecting the optimal expiration when you're selling cash secured puts. Basically, when we're looking at that aggregate theta chunked into common divisible time frames, we're also looking at the implied volatility, because what is implied volatility? It's how cheap or expensive the option is. It's just that simple. It's how cheap or expensive the option is. And so we prefer to sell the option that has the higher implied volatility. That's kind of overridden by that aggregate theta chunked into common divisible time frames, because that tells a better picture. But looking at the term structure is just another criterion. So if I'm looking at this one strike price that I'm choosing between three different expirations, if the 7-day ones have an implied volatility of 27 and the 14-day ones have an implied volatility of 29 and the 21-day ones have an implied volatility of 22, well, I want to sell the 14-day ones that have an implied volatility of 29, the higher one. That is one of the criteria that comes into play. And vertical skew does too. Vertical skew, which is that observation that options of different strike prices within the same expiration have different implied volatilities, that comes into play in such a way where, hey, if the 120 puts have an implied volatility of 31, the 119 puts have an implied volatility of 32, well, the 119 puts are better because it's a higher volatility level. Now, there's kind of a lot to unpack there, and I don't know, maybe we'll do an episode about this in the future. But with most stocks, the vertical skew is such that the lower the strike, the higher the implied volatility. So if you follow this strictly, you'd always want to sell a lower strike, and at some point, you're just not collecting enough premium. That's not true with all options. With some of them that are short squeeze candidates, or they're just the sexy highfalutin ones that can really take off to the upside, that are like crypto ones or something like that. They might have lower volatilities the lower the strike. So that's just another one of the criteria to use. And I would say vertical skew when it comes to put selling, it's somewhat important, but it's probably not your major deciding factor. Now, one more thing here, kurtosis. So when we talk about these pricing models and we talk about the log normal distribution, this idea that most of the moves that occur are smaller moves, but every once in a while you get a bigger move. Well, in reality, in the stock market, that log normal distribution that professors originally said, hey, this is how stock prices are distributed statistically. Well, they actually have what we call fat tails. Okay. Highly unexpected events happen much more in the stock market than the log normal distribution math says they will. When the probability curve is modified to reflect the greater chance of those outlier events, well, the tails, the big moves, which is where the bell curve looking thing, right? The log normal distribution kind of goes down towards 0%. It goes up a little bit. And those are the tails, and they're bigger, so they're fatter. They call them fat tails. That is called leptokurtosis. And it gets us to a closer model of reality. But the really big moves happen more severely to the downside and more often to the downside compared with the upside. So even a pure leptokurtosis may not exactly explain what is true in real life. And further, humans make option buying and selling decisions and act on them. And humans have emotions. Fear is to the downside. So the lower strike puts tend to be more expensive for a reason, for a couple of reasons. The big moves need to be priced in more to the lower strike puts, and they tend to be a little too priced in because of the human emotion of fear. And that's bad for people who are buying puts to hedge, but that is great for us. To help talk about this, I want to bring on someone who's helped out hundreds, probably thousands of traders to use cash secured puts in order to trade into a stock they want to buy or to skate and just pick up a little extra premium. He's a frequent guest and a good friend to the show. Please, again, give a warm welcome to John Kmiecik. Hi, John. Welcome back to Wealth Building with Options.
Good to be back.
So, we've been talking today about basically three different things to help us choose what strike and what expiration as far as writing cash secured puts goes. And the first one, they probably go in level of importance. The most important, I would say, is having a good old-fashioned support line on the chart. Now, we have been talking about trading together for a really long freaking time, decade and a half or something. I don't know, a long time. Yeah. And I know that support and resistance lines are really, really important things to you and to me too. So how do you guide your students on using support to set strikes for cash secured puts?
Yeah, as you mentioned, that's in my wheelhouse. I live and breathe support and resistance levels. Obviously, we're talking about support here for cash secured puts, looking for optimal opportunities. But yeah, I like to use multiple time frames as well. We've talked about this in the past about how aggressive, so to speak, quote unquote, you want to be with your cash secured put. Do you really want to own these shares, or are you thinking more this is a high probability premium selling kind of routine? So I actually like to look at even like the hourly time frame and look for various minor support levels as well. And I actually did this with someone just this Tuesday when we're recording this, just the day before, but we talked about multiple levels, and based on what their thought process with, do they really want to acquire the stock? We went over like several multiple potential support levels. Now, not every chart is going to allow that, but it's more ready available than you think. So you break down these on different levels, and we do that all the time. And to me, I like to do that because you look at a daily chart and there's going to be a support level. Sometimes it's not in the general area code and it just doesn't make sense to use that. But there usually is a plethora of other minor so-called potential support levels. So to me, I kind of like to use both based on how aggressive, how much they want to be assigned or putting that probability in their favor. So to me, it's optimally important going along with theta and implied volatility as well.
And you mentioned a really interesting thing there, multiple time frames. And that's something that we haven't really talked about yet here. Tell us a little bit about that. How do you use multiple time frames for looking at support to help make a strike decision?
Yeah, and I always say this goes back to when I'm teaching young virile minds on technical analysis. I always say just don't get caught up on the daily chart. When you're practicing looking for trends, support resistance levels, even using moving averages as those levels, it's so nice to use smaller time frames to even get better at that. Then what does that translate into? Real life experience as an option trader, as a technical analysis. So I definitely, for me personally, I love using the hourly time frame, but I also move to the 15-minute time frame as well. And there's so many levels that sometimes you won't see with the naked eye. Now, there's Captain Obvious spots where you're looking at a daily time frame, you do see support there, but there's so many times like, all right, I always like using the analogy of putting it under a microscope when you go down to these smaller time frames with charts. And there's so many other levels that work so well. I mean, even I'm a big 50 and 200 moving average guy as potential support or resistance, but it's crazy. We'll look at an hourly chart and see so many times that the stock will use that or whatever we're trading as a support or resistance level. And that's why I kind of look at that as potential cascade put, areas to sell correlating with the strike price around those levels.
And here's another thing we didn't really talk about yet, but I wonder if you have any other technical analysis things, indicators, or what have you, that you might use for selecting the strike for cash secured puts too.
Other technical analysis stuff, to me, that's for sure the most important. But I have looked at, in the past, I've looked at some Bollinger Bands looking for levels like that. And then even, I'll be honest with you, I've even used like the MACD, looking for levels there, looking for bounces and so on and so forth. But to me, I definitely I'm always open. I always say, you know what? Just because I don't use them at length doesn't mean that they're bad. But I definitely have found that support and resistance levels have worked best for me over time. But certainly, I do not dismiss anything because, as you always say, Dan, anything that works, I'm never going to dismiss it, even if it sounds crazy. And yeah, so I have in the past, but currently, I kind of really just use support levels for cash secured puts myself.
Yeah, that's definitely the most important to me. I'll use RSI a little bit, especially like when it's oversold.
True.
Yeah.
I forgot to mention that one. I couldn't come to my head when we're speaking, but I have used that in the past too, honestly.
And it's funny you talk about having used these things in the past. Isn't it funny about just how the trader's mind works, where like our big thing and part of the reason for this whole show is how it's so important to have a plan and to stick tightly to that plan. But you always still have to try new things out because you want to make that plan better.
It's funny, when I first learned technical analysis, I had a million things on my chart. As you're learning this stuff, they always show you the best examples like, oh my God, I remember learning this. I'm like, do traders know this? That every time it crosses up the MACD or RSI, you buy here, you sell here. I'm like, oh my God, I am going to be rich beyond belief knowing this stuff. And then the more you use it, you're like, maybe it's not as dependable as I thought. And to me, the one that stuck around with has been the support and resistance levels. Made it through thick and thin with me. So I've divorced a lot of technical indicators, but I'm still married to support and resistance.
Isn't it crazy how that's like kind of the simplest one, but it's just the one that works the darn best, I think.
Yeah, it truly is. And to me, it frees up a lot of chart space as well. And even moving averages, I always tell people you got more than 5 moving averages and you got a lot of clutter on that screen. Clean that stuff up.
But what about all the colorful eye candy on the charts, John?
I think people do get lost up about that. So yeah, I mean, trust me. Speaking of cash secured puts, I had a student, it was a couple of weeks ago, and he had all these things on there. I'm like, how do you even know what level you're looking at? Yeah, oh, I'm selling this strike for my cash secured put. I'm like, why? Because that purple, the blue, and the yellow line are crossing there, whatever the heck those are. And it was funny because he really couldn't even remember what a couple of those lines were. I'm like, there's your answer, right? Clean that mess up. Clean that mess up.
Yeah, man, with trading, keep it simple, stupid.
It is fun. Just traders, there's just like humans, there's so many different personalities. And as traders, there's so many different personalities as a trader too. It's crazy.
But one of the other things we talked about in this episode is Theta, which we talked, you were on the episode with covered calls when we were talking about using Theta for selecting maybe more expiration, but a little bit strikes. You have any good tips that you share with students on that, or just some thoughts on it maybe?
Yeah, I mean, just in general, of course, people just look at, and I know you talked about a little bit earlier here, just the flat theta number, the bulk of it. And I've had so many traders go out months and months on their cash secured puts and the cover calls as well, because they just look at that gaudy $800, so to speak. And to me, you got to look deeper. And just because we have a plethora of weeklies and dailies, of course, with the index ETFs, but doesn't mean you necessarily have to do that, because I know you mentioned it. I rather look for, because generally you will see higher IV levels with closer expiration, then they kind of sink and they slowly go up. So I think it's a fine line between picking, of course, the support levels that we just talked about, the implied volatility levels, and looking at the theta levels too. And I think people look at theta levels and they think, all right, theta is going to increase as they get closer to expiration. Well, that's for around the money strikes, right? Because you'll look at a theta, and based on what it's showing you in that day, like you do the math, I'm like, well, it's 40 cents worth of theta left. And it's showing, I've got 10 cents a day with 2 weeks to go. We'll do the math. Is theta going to increase as you get closer to expiration if the underlying doesn't move where it's currently trading? And the answer is no, right? It's going to get smaller. So I think it's a plethora of not just picking a support level, but picking the perfect expiration with the IV and kind of knowing what theta you are actually getting based on the actual overall theta, not just the current theta that's showing. I think is really, really important too.
Yeah, right. Which I call the aggregate theta. Just look at there's this much time premium between now and expiration. Look at that. So yeah, I guess you have to do a little bit of math as an option trader, huh?
And that's the hard part, where a lot of people are a little sore in that they haven't been to math since high school or college, and it's gotten a little bit withered away. So yeah.
Oh man. Yeah, it does wither away. Like, geez, I was just talking to Bobby this morning, and like I just did some simple division in my head and I type it and he's like, what are you talking about? I was like, oh geez, I was like way off on this. Oh my gosh.
Usually you're pretty good. I'll give you some credit though. So yeah, my smart math skills came from being a checker at a grocery store when I was growing up. I'm not sounding like an old person, but that's before checks and credit cards. And the bill was $17.77. I know they're going to hand me a 20. I'd be figuring out in my head. I'd get that money ready before they even handed me the bills. That's why I've always been pretty good at math. And then, of course, trading options always makes you a lot smarter too. So especially when you have to teach options on the fly, like I do in my class.
Oh my gosh. You know what? I used to be so good at fractions when we traded in fractions.
Oh, yeah.
Because when I became a market maker on the SIBO, they were still trading in stocks were in eighths and options were in sixteenths. And so being a market maker, like you had to be really fast at doing these in your head, because then you beat everybody else in the pit and you make more money. So I got myself one or two sheets of poster board and created these like little flashcards and just wrote out all these fraction math. And every day on the train going to the exchange, I would just do flashcards.
Just to get stronger at it, right? And remember.
Yeah.
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 So no, that's smart though. I mean, because let's be honest, fractions are dead in this world. You don't see fractions at all anymore, not let alone option trading in stock, but it's dead. Thank God there's no trigonometry or calculus in option trading. Otherwise, we'd all be sunk.
I know, man. I was talking to a friend of mine the other day, one of these friends I get together with like 3 times a year, and we just talk about all this weird, crazy stuff. And he was talking about, okay, if it's like the end of the world and I'm the one person left and somehow I end up in charge and have to rebuild the world from the ground up, one of the things I would do is put math in base 12 instead of base 10, which is like, for people out there who aren't sure what I'm talking about, like our system, we go 1, 2, 3, 4, 5, 6, 7, 8, 9, and then 10 is like the cap of that. And then it's like 1, 0, and then 11, 12, and then it goes to 22, 0. So it's a system based on 10 being the turning point. But it doesn't have to be. It's just that way because the typical human was born with 11 digits, 11 fingers, or 11 toe, or well, oh my God, wait, I was born with 11 fingers, but typical people aren't. Typical people are born with 10 fingers. So anyway, but that's why we have the base 10 system, but it doesn't really divide evenly into everything. Like half of a half is 2.5. That's weird. It doesn't divide into 3. So if it was base 12, that would be so much more useful. But anyway, that was just
yeah. Well, I just think there was edibles or alcohol or both involved in that discussion, though.
Actually, he is an AA person who's been sober for many, many years. And
I know you're on the wagon too. So, but yeah, but maybe you should have been.
Right. Maybe we should. So anyway, so yeah, Theta.
Yeah, I think too many people put too much emphasis on it, but then there's others that don't put enough emphasis on it. So it definitely goes both ways. I mean, especially as we've talked about, I think in the past too, about this option is going to expire worth this, right? I've got 4 days left and there's 10 cents left of premium on there. Well, do the math. Is it worth holding? And I always say, even if you don't sell more premium against it, aka another cash secured put, you know what? Sometimes take the risk off the table unless you truly do want to own those shares. But a lot of times it's still not worth it. I would rather sell another strike closer to where the underlying is trading and bring in a bigger positive theta and then take possession of the stock if I'm assigned too, though. So I think it's another big factor when it comes down to theta too.
Yeah, I love that strategy of rolling, even though you want to get assigned. I love that. Love it. And then implied volatility. And we talked about this prior to recording the show. I said it's a little bit useful for strike selection within an expiration, but that's probably the least useful use of it. Like, I think you were just questioning if it's useful at all for strike selection, which is fair.
It's still useful in expiration selection, though. I think you pointed that out as well. Then, so which I agree. If it's they're announcing earnings and it's certain that's a different type of machine, so to speak, and stuff. But yeah, but certainly maybe going out to get a little bit higher implied volatility another week in conjunction with that potential support level and the theta level certainly makes sense to take a look at that. And I'll be honest, I'm guilty as charged to kind of forget about that at times as well then too. I've had some seller's remorse after the fact, like, this would have been probably better if I would have just been maybe not impatient, but just more cognizant of looking out there. We're still human as well. So sometimes we know this stuff, but we forget to use it too, because there are a lot of moving parts with option trading. So that's why it's a lot to think about as you're doing it. That's why, again, getting back to the trading plan, writing things down, it's a good refresher course to even check that. Am I doing everything I said I'd look at for this cash secured put? And these are perfect things to write down that we're talking about here today.
Oh yeah. It's a 3-dimensional chess when it comes to options.
Yeah.
Even for something so air quotes simple as cash secured puts. Yeah, I do think that people oversimplify cash secured puts and covered calls for that matter.
Yeah, I think even more so on cash secured puts than cover calls, to be honest with you, too. I think it's more of a fine art than even the cover call side of things, for sure.
Yeah. Well, you got anything else to share with our listeners here, Johnny?
No, I think that's about it. Again, hopefully all this talk is, I mean, honestly, I've recommended your podcast to so many people that are just getting into trading and options trading. Like even I went away with my wife and a girlfriend of hers, and she knows what I do for a living, and she was asking me about, and I sent her the podcast, and she's like, you know what, I really want to follow that. I really want to get better at this stuff. I think it's helping a lot of people, and like I said, this is fun for us to talk about it as well. But yeah, but hopefully people are listening. I know they're listening, and yeah, it's helping a lot of people.
Yeah. I mean, honestly, I guess there's such good ways to learn stuff. Like you multitask, you really just get absorbed into it, the storytelling and such. I listen to a ton of them.
Yeah, and it doesn't have to be boring. Option trading doesn't have to be boring. I mean, making money should be boring because you're following a plan and it should be as go, but it doesn't have to be reading these books from the 70s and straight lace. So this is just a nice combination of having fun, but talking about things that weren't known about a long time ago. And through our experience and bringing it to you, it's been great and it's been fun and it's been helpful for me as well. That's for sure.
All right. Well, thanks, John, for sharing your time and knowledge with our listeners.
Thank you so much.
And that about wraps it up for this show. But before you go, help grow the Wealth Building with Options community by subscribing to it in your favorite podcast app. When you do, you will be the first to hear episode 20, and that's going to be a fun one. We'll see you then. And in the meantime, invest excellently.
Options involve risk and are not suitable for all investors. Before buying or selling an option, read characteristics and risks of standardized options. A link is provided in the show notes. To learn more about your host, Dan Passarelli, please visit markettaker.com.